We are back in the black hole of real estate, and I got a couple of questions this week regarding insurance. And it was about condos, and I thought it might be a really good time to talk about where things are with insurance for condos and maybe sprinkle in a little bit about, just single family homes as well. This is your host, Ron Wysakarski, for the black hole of real estate. The insurance industry has seen just tremors going through it in the past few years. Rates have skyrocketed because insurance companies have lost a lot of money. And kind of like Vegas, they don't like to lose money. Matter of fact, they hate losing money. And they're going to pass it along to the consumer. There have been many insurance companies that have gone insolvent, and those policies have had to been pushed on to other carriers. And now we're in a situation, especially in condos, where it's getting a little dicey. So here's what's going on. We have so much going on in the industry, especially in Florida, because of the hurricanes. And then you add in the tragedy in Miami where the building collapsed. And there's a couple points of risk that are hot button issues, troublesome things for the insurance industry. Now, across the nation, you've got the fires out in LA and any number of other things that have taken place, throughout. I mean, the hurricanes that went through in the Carolinas. I mean, that puts a lot of pressure on insurance across the nation. And while we might say, geez, it's really expensive to insure a property on the coast or in Florida or in a flood zone, what I would tell you is this. They're taking their losses and their wins nationally and applying it across the board. And maybe, due to sensitivity of certain areas, the premiums are higher because the risks are higher. But what we're really finding right now is that the cost is such that people are looking to, shave a little off, maybe cut a corner, maybe underinsure. Some are self-insuring. I think you find a lot of people that if they got the property free and clear, they might just want to save that premium every year and hope that nothing bad happens. And that's a real thing. Specific to the condos, if you're in a condo building that's more than 2 stories tall, you've got a milestone meeting that's really taking front and center stage. A lot of the real estate sales, when you list the properties now, they're actually including in there, has the association achieved the milestone meeting? Have they done that part? Have they done the roof, the balconies, the common areas, the elevators, the common HVAC, those things. And they're digging deeper and deeper into that in order to ensure the associations in the building. Now think about this. The building itself, let's say from the walls, outside and all the grounds, that would be one insurance. That's the homeowners association. They get a premium for the year and they divide it somehow, some way among all the owners of the condos. So if there was 100 owners, you would just take whatever's due on the insurance and divide by 100, and that's your number. Well, that's certainly one way to do it, but there are places, and I've got a condo in a place where if you have a studio, it's one price, a 1-bedroom, it's another price, a 2-bedroom, and then finally a 3-bedroom, all different prices based on number of bedrooms. I've seen places break it down by square feet. There's a number of ways to do this, but ultimately, the 2 most popular ways divide by the total number of units or the bedrooms and apply each of those accordingly until it covers the premium. Also keeping in mind that within the HOA monthly fee, you may see that the cost of the insurance and all the other bundled items is lower than what the actual amount that you pay every month is, because they're building reserves. Money that's being set aside for the roof and the balcony and the HV system outside and common areas and parking lots and striping, you name it, all goes in there. So that on a future date, when the bill comes in, they're less likely to have a special assessment. That could also affect the carrier's rating. If there's healthy reserves and a relatively good building, or maybe everything's fixed up, that could be a lower premium. But for those who are somewhere less than that, now you're running into still have to ask assessments. Maybe it needs a roof. Maybe it needs balconies. And I could go, concrete projects. It could be on the water. There could be a seawall needs to be built. The pool, maybe the water came in, the waves hit, went underneath the pool, and excavated underneath, and the pool collapsed. I mean, these are real things happening. That's super risky to the insurance company because they know that they're more than likely to pay out. When the premium gets so high that the association cannot sell it to the board and the owners, the cost of what it would take per person, per unit on a monthly basis, now you can look at underinsuring or insuring differently. Think of it this way. If there's a condo and the association fees were $900 a month, and in order to get the right insurance, I had to take it up to $2,000 a month, because this is happening. Some unit owners are not prepared to pay $24,000 a year for an HOA fee on top of whatever debt service or mortgage they have and taxes and utilities. It could become a very expensive proposition. So when that happens, well, those people want to sell. And of course, because that's a weak position to sell from, it's not allowing prices to go up in the building to cover, if anything. You might find that the association is underfunded with people not paying their HOA dues. And of course, those would have to come due on sale if there's enough money, and that gets dicey as well. But think of it this way. If you cannot afford the right insurance to replace the building if it's lost or damaged in such a catastrophic way that you cannot repair it, in essence, you have to demo the building and start over. Well, if that's the case and you don't have full replacement cost, the unit owners now own their fraction of the dirt below it, I guess, because there's no way to rebuild that condo for the money that's available unless they do another gigantic special assessment for the construction assessment. And you can only imagine this. If they're $1 million short to demo the building and put it back up, and there was 100 owners, they might all owe, I don't know, 100, 200,000 each in order to, get the building back up. Hey, even if it was 50,000 each to get the building back up. I mean, these are big numbers. So when we look at the cost of insurance on condos, it can absolutely freak you out. Because you're thinking, well, geez, if I buy this condo and something really bad happens, am I out all that money? Well, when you're making the purchase and you're doing the investigation, reviewing the condo documents and declarations, I would go straight to the budget. I would look for the reserves. I would absolutely be checking the insurance policy and find out if it says full replacement costs, what endorsements are against that, and what the what's it going to cost? Because there's always a deductible on there. Is it a deductible, a few thousand or a few $100,000? Because if it's short on the deductible, that will automatically get assessed to all the owners to cover the deductible, unless there's gigantic reserves in there, which if they're already doing this with the insurance, I'm guessing the reserves are not super strong. And now you're thinking, well, geez, why do I even want to buy a condo? I'm like, well, there's a lot of associations out there that have done all the work. I've got 2 different condos, and I did a lot of research before I ever bought. It was before the Miami collapse, it was before a lot of these things. It was years and years ago, probably 10 years ago. And what I noticed was there was a different threshold of things that had to be done if it was 2 stories or less. And so I went with that. And that worked out to be a good decision for me. But we still had special assessments. But on my condos, both balconies, both roofs have been done. The common areas, right now we're down to building painting on one. The other one was completed. So we've done everything. We've met all of our meetings. And what that tells me is the condo that we have, and it's not for sale currently, and I don't know that it would be, but my suspicion is for somebody who's looking to purchase a condo, ours would ultimately be a safer place to park your money because we've been through all the assessments. We've been through all the thresholds. There's nothing left for us to do other than keep it clean. Whereas a different building could have inherent risk of when's the time for the balcony? What will the cost be at that time? Will I be able to use it? Because, we went through the thing where it's, the balconies are partially or shut off during the day or completely shut off. Definitely an inconvenience. Even just trying to park there, all the construction equipment and all the vehicles, you're parking around the corner or off-site, super inconvenient. So the insurance unfolds into many other layers. What I would suggest, if you're looking for insurance for the condo, go right to the HOA meeting, the minutes, the agenda, things I talked about. But then also inside, you're going to have some sort of liability policy for yourself or contents, kind of like a renter's insurance policy, except for you own it. Because from the walls inside, you would want some coverage in case your bathtub or toilet overflows and does damage to the unit downstairs. You may want some slip and fall stuff if you got guests coming over and they slip and fall inside of your property, or you're running a party and somebody, I don't know, just bumps into somebody and gets hurt. That's important. Maybe you carry a lot of possessions or artwork or jewelry or things. So same things in your regular home. You're going to want some sort of policy that covers the inside and your contents. That's the two types of insurance. One's relatively simple for the condos and the liability piece. The other piece we've talked about for the last 10 or so minutes, that's the tough one. So insurance, it's readily available. I believe that most condos are still getting full replacement costs, but I've noticed that others are moving towards something less than full coverage. And what it usually means is banks will not lend money if it's less than full coverage. And ta-da! Those buildings are now cash-only sales. Very, very infrequently will you get a lender that will lend under those conditions. So if you're on a condo board and you're thinking of, hey, how do we save some money or make it more appeasing or palatable to all the unit owners that don't want the HOA fees to go up, just let them know when it comes time to sell. They'd have to sell for cash-only buyers in most cases. That would limit your buyer pool to less than half the buyers out there, and that might affect your pricing as well. So trying to save a little bit of money can actually make your condo less attractive, less desirable to buyers, and a lower cost to the buyer, which ultimately costs you money. In fact, I've seen the drive down in sales price in these situations far exceed what a special assessment or the HOA fee might have cost. So give it a lot of thought. That's my take on the industry of condo insurance. And we'll get back to talking about homeowners insurance again. We've done that recently, but the condo, that's the one that's really the hot button issue today. So if you got questions about it, definitely send us a comment, drop us a line. Absolutely subscribe, and hey, give us a thumbs up and 5 stars. This is your host, Ron Wojciechowski, for the Black Hole of Real Estate.